Hi, I'm Ben from Motivation to Invest. Our mission is to help motivate you to invest for your financial freedom by providing you with valuable investing tips and strategies. This may help you escape the 9-to-5 rat race or just improve your quality of life. Whatever your goal, putting your money to work rather than you working for your money is what all successful investors do. In this video, I'm going to outline why now is one of the greatest times to start investing. Share prices are down, the stock market is low. It's a great time and a great opportunity to get in there. Let's dive in. The world is currently in the midst of a virus epidemic, which has created stock market uncertainty and share prices to decline. If you already had a share portfolio, you would have seen thousands of paper losses wiped from your account. Now remember, these losses are only paper losses, and they only become real if you sell your shares during a low point and crystallize that loss, which I would not recommend doing. The best strategy is to hold on to your stocks and your shares for the long term. That's the same strategy which the great billionaire investor Warren Buffett uses. Is the world about to end, or is this the greatest time to invest in the stock market? I believe it's the latter. In the words of the great billionaire investor Warren Buffett, be fearful when others are greedy and greedy when others are fearful. Or in the words of James Caan, the millionaire from Dragon's Den, observe the masses and do the opposite. This market crash is the perfect opportunity to heed those words of wisdom. With stock prices at an all-time low, investing now means you can get great returns in the future. This is not the first stock market crash we've been through, and it won't be the last. The stock market crashes roughly every 10 years, and there has been 4 notable ones within the past century. From the Great Depression in the 1930s, to the dot-com bubble in the early 2000s, credit crunch in 2007, and financial crisis in 2008. Market crashes have come and gone over the past 100 years, and this one is no different. The stock market on average takes 2 years to recover fully from a stock market crash. Many of the most successful investors in history state stock market crashes are the best time to buy, and it makes complete sense. If the idea is to buy low and sell high, you're never going to get a lower point than at a stock market crash. But what most people tend to do, they tend to buy high and sell low. They tend to panic and sell all their shares to recoup their losses. And then when the market's going good, they tend to buy in. You should do the opposite. But don't just take my word for it. Observe successful investors. Warren Buffett invested $45.3 million into Delta Airlines during this latest stock market decline. Heeding his own words of advice, he was greedy while others were fearful. With the airline industry on its knees and stock prices at an all-time low, Warren Buffett chose to increase his share in the airline company. How can you take advantage of this situation? Well, start investing. As the old Chinese proverb says, the best time to plant a tree is 100 years ago. The second best time is today. If you have some cash to invest, now is prime time. You can start investing from as little as £10. So what should you invest in? Now, it must be stated that I'm not a financial advisor. Investing is highly dependent on your own personal circumstances. What I invest in may not necessarily be what's best for you to invest in. But what you should do is follow my method and follow my strategies in my thought process of how I come up and did these investments. Because it's not just about what capital you've got, it's about timing the market, it's about how long you plan on leaving the money in the investment for. Are you close to retirement or are you in your 20s? It all makes a difference. If you're close to your retirement, you're probably more likely to have a higher percentage of bonds rather than stocks, because bonds are more stable and more secure, which you'd want close to your retirement. However, if you're in your 20s, You may prefer to invest more in individual companies and index funds and share portfolios because they're slightly more risky, but you don't need to touch the money for 10 years, 20 years, or whatever your figure is. So there's a variety of methods and strategies, and I'll detail some of them in this video. Now, the investing strategy I follow mirrors that of the great investor Warren Buffett. Warren Buffett invests in companies with the following. The first is strong balance sheet and cash flow. He looks for companies which have good earnings and he can see a long-term future in that business. The second point he looks for is companies which are market and industry leaders. Companies such as Coca-Cola, companies such as Apple, Microsoft, Amazon, Google. These big giants lead their industry. He even previously invested in Gillette, and he made a comment stating that every night he goes to sleep with a smile on his face, knowing that in the morning every man has got to shave. These companies are unlikely to go out of business within the next 10, 20, 30, 40 years plus. So it's a great investment for the long term. He also looks for companies with low debt. This is especially important if you're investing during a recession. Companies with low debt have a much better chance of surviving through a recession as they have enough cash on hand to cover all their running costs and expenses during a crisis. Companies with higher debt, however, are much more unstable and risky when it comes to investing during a recession. Also, you have to think about the company's book value. So if the company went bust and had to liquidate and sell all of their assets, what would their true value be? All of its factories, all of its machinery, all of its buildings, whatever it had to sell everything. Now, if that value is higher than the share price or similar, then it's a great investment. If it's much, much lower, i.e. if everything was sold, there's nothing left for investors, then you need to be worried, especially if you're investing during a recession. And last but not least, Warren Buffett selects companies which are below market value. And the greatest time to get companies which are below market value is during a stock market crisis. A great analogy Warren Buffett uses to explain the stock market is something called Mr. Market. Mr. Market is a bipolar, manic depressive individual. He wakes up every morning and the slightest negative thing can send him hurtling into a deep depression. For example, he wakes up in the morning, he burns his toast and he plummets into a deep depression all day. This is the same analogy which can be mirrored with the stock market. The stock market can hear some bad news which doesn't actually directly affect the company, but it can plummet massively during a day, during a week, during a month. But over time, the stock market usually corrects and traces earnings as the company grows. To summarise, the stock market in the short run is a voting machine. In the long run, it's a weighing machine. So the weighing machine will dictate its true value, the true value of the business and the true value of the company. But in the short term, it could get a lot of low votes one day. The mood, the sentiment can be bad for a certain company one day. But if the company actually has a strong balance sheet and is actually a market industry leader, then you should have no problems. But the best opportunity to buy is when there's bad sentiment in the air for that company. That's when you should look at the company in more detail and say, well, actually, is there any issue? Has Mr. Market just burnt his toast? Or has he lost his job? Has he lost his home? These are real issues. The toast is not an issue. But the sentiment will be the same in the stock market, whether Mr. Market has burnt his toast or lost his house. That's how irrational and up and down the stock market can be. So as an investor, you need to use that to your advantage. So which companies have I invested in? Well, firstly, I'll say the key is not to follow my exact investments because my personal situation will be different to your personal situation. and everyone else's personal situation. You need to look at where you are financially, how long you plan on doing your investments for, how much money you've got to lose potentially, because investments can go up and down. Are you the sort of person which, when it goes down, you'll want to sell? Or are you the sort of person which you can be very logical and you can just stick to your strategy? Because that's the way you win the game. Timing is also a crucial factor in investments. At a certain time that someone invests, they may have got a much better deal than someone in the long term. They also might have a different exit strategy. Someone may have invested and they're happy to keep the money there for 20 years. Someone else may have invested and they may need it in 1 year to pay their mortgage. So these are two completely different type of people, which one of them will not need the money in the short term, the other one will. And to be honest, if you need the money in the short term, I wouldn't even invest. You should only invest what you're happy to keep there for the long term, unless you want to do trading, which is a different story. The first investment I did was in an index fund. Index funds have been regarded as the safest, most passive and lowest cost form of investment. They've even been known to outperform managed investment funds due to their low fees. So if you want somewhere to put your money and forget about it, an index fund is for you. If you're in the UK, you should look at the FTSE 100. This is the top 100 market cap companies across the UK. These include BP, Shell, RBS, many large banking institutes. This is a very, very safe investment, and currently it's at an all-time low. So it's a great time to get in there and start investing. Now, as they say, elephants don't gallop. And as the FTSE 100 tracks the 100 largest companies and the FTSE 250 tracks the 250 smaller cap companies, the FTSE 250 can offer greater returns but is also greater risk. So that's just something to keep in mind. For worldwide diversification, you need exposure to the largest economy in the world, the USA. One of the greatest index funds which you can use to track the US economy is the S&P 500. This is the top 500 market cap companies in the USA. Companies such as Apple, Microsoft, Amazon, Alphabet, which is the parent company of Google. These are great companies which in one investment you will be diversified across the whole range at a very, very, very low fee, or even free if you're using one of the apps. Now, the S&P 500 has been on its largest bull run in history, which began back in 2009. If you invested back then, you would have seen a 330% rise in your investment. However, it has been known for a while that the share prices in a lot of the S&P 500 were valued much higher than their earnings. Thus, a market contraction was predicted. Now, due to this latest crash, the S&P 500 has dropped to a more reasonable level. Still high, but it's still a great opportunity to get your foot in the door. Index funds are a great place to start for anyone looking to take advantage of the great investing opportunity at the moment. My favourite funds include the Vanguard FTSE 100, the Vanguard S&P 500 and the Vanguard Life Strategy Fund, which gives you worldwide diversification in one single investment. If you have some cash to invest, now is prime time. You can start investing from as little as £10, and there are a variety of free trading platforms which offer zero fees and even free shares upon sign up. I'll leave a link below. These range from Free Trade app to Trading 212. These are two of my favorites which I use all the time. For higher risk investments but with potentially higher returns, you can also invest in individual companies. In the next video, I'll detail which individual companies I invested in during this latest market crash. You can look at the strategies I used and the methods of selecting these companies. If you found this video informative, feel free to like, comment, and definitely subscribe for more content like this. Thanks for watching.